count up has slowed, so we will begin. Good afternoon, and thank you all for joining us for our annual Waddell and Associates Outlook. I am Teresa Bailey, Director of Development and a Senior Wealth Strategist here at Waddell and Associates. Our Chief Investment Strategist and CEO, Mr. David Waddell, will serve as your pilot today and present his 2022 outlook titled Cleared for Landing. Today is February 22nd, 2022, so lots of twos for this Tuesday afternoon. For the next 40 minutes or so, please fasten your seatbelts for David's captivating presentation on the current economic, investment, and political conditions. For those of you joining us for the first time, Waddell & Associates is a wealth management firm dedicated to enriching life by providing clarity. David is often featured on CNBC, Fox Business, Forbes, The Wall Street Journal, and Barron's as an investment expert. We're so lucky to have him. We'd love to hear your questions. Please feel free to submit them down below in the Q&A feature. We will do our best to get to as many questions as possible after we've arrived at our gate today. For any questions left unanswered, please also leave your email address with the question, and we'll make sure we can answer those directly after today's presentation. A recording of this will also be available on our website at www.wealthstrategists.com. With that, cabin crew, please take your seats, prepare for landing, and stay tuned for David Waddell.
Thank you, Teresa. You may now return to the cabin. Welcome, everyone. And by the way, you look fantastic. I feel a little underdressed up here in the cockpit, but they sealed the doors and maybe nobody can see. So welcome, everyone, to our 2022 Outlook presentation. And I've titled this presentation, Cleared for Landing, to evoke a couple of big ideas. One, it's time to turn the autopilot off and resume operational control. Investors must be more actively engaged as the economy descends from the post-COVID highs. And 2022 will be a year of transition as macro policymakers try to navigate us safely back down to more normal economic operating conditions. Second, landing is not easy. As things decelerate, it provides us with greater risks and the potential for less reaction time to manage those risks. In fact, while landing only accounts for 4% of total flight time, it actually accounts for 49% of total fatalities. So therefore, while global monetary and fiscal authorities work to cool this overheating economy, we've got to remain very aware, very alert, and very vigilant to safely navigate our descent. Before I begin and safely navigate the descent, I have to safely navigate the SEC. So here are some disclaimers for your viewing pleasure. And then once you've finished reading those, I will take us back into the air and to our dashboard. All right. This is where we began 2022. GDP ended the year at 5.5%. Inflation ended the year at 7%. Think of GDP kind of like our speedometer. Think of inflation kind of like your temperature gauge. And then interest rates, and when I say interest rates, at least in this context, I'm referring to the 10-year Treasury yield, ended the year, or began the year, I should say, at about 1.5%. Think of interest rates as sort of your coolant levels. For us to safely land back in 2023, we have to return back to more normal operating levels. The levels that I just went through with you that we began the year with are widely divergent from the norms. More normal operating levels would be a speed limit of 2% of GDP, nice cruising speed. We'd have inflation maybe around 2%, which is the Fed's target rate. And then we'd see interest rates about 2.5%, which is basically correlated with, kind of nominal GDP, but historically probably about the most appropriate level for where things stand when we're back into a safe operating environment. But to get down there safely, we have to navigate through some headwinds and some turbulences. And so this is going to add the framework for our discussion today on the 2022 outlook. There are three major turbulences that we have to navigate to safely land back towards more normal operating levels in this economy. Turbulence number one is inflation. The question being, is the inflation going to be transitory, or will it be something more threatening, more permanent? Our turbulence number two is valuation. Can today's high valuations persist? Are they sustainable, or are we vulnerable to larger valuation corrections? And then finally, from a government's perspective, the federal actors, the monetary and fiscal authorities, were super active around the COVID experience, and now they have to figure out how to unwind, cool off this economy, get us back down to a normal operating rate. And the question is, can they help us safely land, or are they prone to mistakes which could create even more volatility and disruption? So we're going to hit each one of these, make some decisions, and see if we can land this thing safely. So let's start with inflation. This is a big, meaty topic, and I've spent a lot of time on it trying to prepare for this presentation. I'm hoping that I can demystify the land of inflation for you in the following slides. First of all, we have to understand where inflation comes from. And inflation comes from the pace of potential GDP versus the pace of actual GDP. This chart here chronicles real potential GDP for the US economy going back to about 1950. Now, this is forecastable because economists know what the demographic trends are going to be, right? They know what the workforce size is going to be because they know how many babies were born 18 years ago. And then they can make predictions about productivity. And remember, economic pace is really just a combination of the number of workers in the economy and how productive they are, right? So workers times productivity. And if you could figure out your demographics, ascribe an assumption to productivity, you end up with your potential GDP growth rate. Now note that potential GDP in the United States has been decelerating since the 1950s, largely because we're getting older and we're not having as many babies. And so from a demographic perspective, there's a little bit of downforce. Productivity basically remains the same. So if you look at what the Fed expects GDP potential to be going out over the next 20 years, it resides around call it 2.5%. Unfortunately, in practice, real GDP doesn't act with such composure. So we get these vacillations around our potential growth rate, some higher, some lower. But in the periods of time when that actual GDP growth rate exceeds potential GDP growth rate, we have more economic demand than we have sustainable economic supply. And that creates a hot economy and some inflationary impulses within it. If you look at where we are today, COVID gave us, plenty of policy responses that we'll talk about, but it gave us a growth rate last year of about 5.5%, which is well above our potential growth rate of less than 2.5%. And frankly, I could have done this chart a different way. Frankly, that's the largest divergence we've had between real GDP growth and potential GDP growth going back at least since 1950. And that's led to some serious inflationary impulse. So in sum, inflation is really created by an excessive amount of actual GDP relative to potential GDP. All right, so with that, hope that made sense. Let's talk specifically about inflationary rates. So this is inflation as measured by the Consumer Price Index, and that's the index we're going to use all the way through the presentation. There are several indices out there. Sometimes I get some debate from people around which indice is most appropriate. The one with the longest history is Consumer Price Index, and so we're just going to use that as our guide star. So this is CPI and the change annually going back to about 1914. And you can see, while there was a period of moderation, call it between 1990 and really 2020, inflation has been pretty volatile in our history. And there are some spikes in inflation that if we go back and mark towards history, we can find some commonalities. So for instance, we had a major spike in inflation back in, call it 1918 to 1920, and that was associated then with World War I. We then saw another spike in inflation in a couple of periods, all of which were very close to around the time period where we were engaged across the planet in terms of World War II. Further down the road, we see another spike that also correlated with the US engagement in Korea. And then we see something a little different. In the 1970s up to 1980, really 65 to 81, we had persistent inflation that wasn't really associated with any wartime activities, although Vietnam played a part. And economists have now referred to that as the Great Inflation, and we'll spend some more time on that. We saw another surge to about 6% back in 1990, coincident with the war in Iraq, the Gulf War. And then we entered into this nice long period economists have called the Great Moderation, where inflation was persistently, well, it behaved correctly for about 20 years up until the COVID experience that we've just had today. So if you look at this, you can see some common denominators, right? Usually spikes in inflation accompany wartime episodes outside of the Great Inflation. And so what are the drivers of wartime inflation and what were the drivers of the Great Inflation? If we understand that, then perhaps we can properly diagnose what kind of inflation we are having today. So let's start with wartime inflation. Go ahead and reopen your economic textbooks to page 1. This is a chart of the familiar to you economic supply and economic demand curves. For orientation, we have prices on the left axis and GDP on the bottom axis. The reason that the economic supply curve slopes up and to the right is as prices rise, producers are incentivized to produce more stuff, so economic supply rises. As prices fall, consumers are incentivized to buy more stuff, which is why that economic demand curve slows down and to the right. Under normal conditions, economic and demand and economic supply will cross, find an equilibrium point, and that will establish general price levels and also the general pace GDP of economic growth. In periods where we get shocks, these curves can shift. So wartime demand, for instance, will put a strain upon the economy as the economy mobilizes for war, as consumers panic and go to the Walgreens and buy all the toilet paper, and as producers scramble to generate supply to meet the surge in demand. And because there is this surge in demand, it takes prices higher, right? And it also takes GDP higher for distortions across the economy. Fortunately, wars end, and in the past, when they've ended, demand has returned back to more normal operating levels, and so have prices and GDP growth rates. So now let's look back into the textbooks and test our theory to see if that is indeed what happened through the course of history. So here are the 4 wartime events that I highlighted in that inflation chart from before. And as you can see, like I said, World War I, we had inflation of around 20%, but 2 years later, that inflation rate had fallen back down to 6.5%. In World War II, inflation peaked around 12.2%, and then 2 years later, it was under 1%. During Korea, inflation peaked over 9%. 2 years later, it was down below 1%. And even in the Gulf War, back during the time of the Great Moderation, we had 6% inflation back in Q4 of 1990. By Q4 of 1992, that inflation rate had fallen down to about 3%. So, theory proven, wartime inflation is transitory inflation. All right, but there was another inflationary episode in our chart, and that was the Great Inflation period. Those of you who followed these outlooks and State of the Unions from the past will know that I always choose one book to rule them all for every topic. This year, that book is The Great Inflation and Its Aftermath, written by Pulitzer Prize winning columnist Robert Samuelson. I think he does a fantastic job diagnosing what caused and remedied the great inflation from 1965 to 1980. So those of you looking for extra credit, or those of you who like to read while aloft, The Great Inflation, Its Aftermath is an excellent, excellent read and my most important book for 2022. So I'm going to rely heavily on some of Robert's propositions here. All right, let's get back into bell bottoms and hula hoops and things and talk about what really happened in the 60s and 70s. Here's a price inflation chart. Again, starts really in 1964, around 2%, ends the period in 1980, more around 15%. And there were a couple of things that really began to cause the unmooring of inflation within the United States of America. One, when the boys came back home from World War II, the government debated heavily whether to have a full employment program. There were 20 million GIs that were going to have to be reintegrated into the economy. Congress thought maybe we should guarantee them all a job. And we almost had a jobs program. I referred to this a little bit last year, if you remember, but we almost had a full employment program where the federal government would just guarantee a job. The Republicans ultimately watered that down, but there was an act passed. It wasn't the Full Employment Act, it was the Employment Act, and it did tie federal activities to the pursuit of full employment. It really wasn't binding, but it was really highly suggested, and it did set strategy for the next 3 or 4 presidential terms, as well as, congressional terms. And so in 1946, we got the Employment Act, dedicating the government to full employment. In 1950, an economist named Phillips came up with the Phillips curve, and the Phillips curve pronounced that there was a relationship between inflation and unemployment. And if you wanted to have really low levels of unemployment to fulfill your full employment sort of criteria, then you'd have to be willing to tolerate a little bit higher inflation. And the politicians and the economies at the time determined that full employment was much more important, that inflation was just an irritant, and so they were willing to tolerate it. So in practice, our story really begins in 1964 when LBJ comes into office. Kennedy had proposed a pretty large tax cut, which was a good idea. LBJ carried it through, but he also added on top of that an enormous amount of government spending for his war on poverty. You may remember it as the Great Society. We got Medicaid, we got Medicare, we developed all these new agencies, et cetera. And so in addition to cutting taxes, he really ramped up government spending a great deal. And then a year later, the US economy found itself in a demand shock from the Vietnam War. And so really at that point, fiscal policy was on full tilt. We had a tax cut, we had a whole bunch of new spending, and then we had wartime spending on top of that. In 1970, we had the election of Arthur Burns, and Nixon nominated Burns. He ended up being probably the most politicized Fed chair in the history of the United States Federal Reserve. He basically did Nixon's bidding and made sure that interest rates were low and that the money supply was high to pursue his objective of full employment, damn the inflation numbers. Well, this spooked our international trading partners a little bit, who began to trade their dollars in for US gold reserves. And our US gold reserves were quickly depleted down to the point where Nixon said, I don't think we should do this anymore. He closed the gold window, effectively ending the gold standard in the United States. The US dollar became a fiat currency and basically began a period of decline, which of course also became inflationary. So what did Nixon do about it? He enacted wage controls and price controls, and he imposed tariffs on imports. And those of you who are in higher level economics classes will know that any of the stuff you do like that just restricts economic supply over time and just exacerbates the inflation problem you're trying to solve. So that really unmoored things. And then, we chose, I guess, to be friends with Israel during the Arab oil embargo, and we got punished by OPEC And that led to a tripling in oil prices, which added even more inflationary pressure. And remember, at that time, the economy wasn't as efficient, and oil accounted for like 15% of the consumer price index. Well, that created a recession. And then Congress doubled down and passed Resolution 133, basically begging the Federal Reserve, which was complicit in all of this, to print even more money and make credit even cheaper, which exacerbated the inflation problem even more. This man, Jimmy Carter, came into the economy. He recognized inflation was a problem. He doubled down on price controls. He talked a lot about energy conservatism. That didn't really work. Then we had the Iran-Iraq war. Oil prices doubled again. And by the end of the period, we had inflation around 15%. We had unemployment around 6%. And I think Fed Chair Miller, who became Treasury Secretary, actually said, yeah, inflation is a problem. We don't really know what to do about it. Carter gave a speech that many remember as the Malaise speech, where he said the problem with Americans, or the problem with America, is the excessive appetite of the Americans. And if we would just trim our appetites, then we ourselves could control inflation. Obviously, that was a failed experiment. Reagan won in a landslide, which cleared a path to finally do something about the Great Inflation 2.0. What they didn't understand during this period that we understand now, and this is really important to recognize, while the Phillips curve might have had a relationship between unemployment and inflation, it didn't contemplate the power of inflation expectations. So if you're in a union and you're negotiating wage increases, and you know that your Federal Reserve is committed to inflationary policies, then you're going to negotiate even higher wage concessions, knowing that inflation is just going to eat into them going forward. And so this persistent drumbeat of inflation expectations became a self-fulfilling prophecy and pushed inflation higher, as everybody just assumed inflation was a thing, and it led to even higher wage negotiations. So to kill inflation, you needed somebody who could actually kill inflation expectations. And we had just that man. This is Paul Volcker. He became Fed chair at the end of Carter's term, was reelected by Reagan, and basically served between 79 and 87, I think, an 8-year term. And what he did immediately was say, we are going to kill inflation. I am going to trim the money supply. I am going to raise interest rates. That immediately caused a recession in 1980. But as you can see, the light blue line is the consumer price inflation rate. It didn't really go down during the recessionary period, at which point Volcker said, inflation be damned. If I have to put this economy into recession deliberately, I'm going to do it. I'm going to break inflation. I'm the man for the job. Now, anytime anybody had said that with previous presidents, the presidents would have given them a lot of political pressure to say, no, you need to cut rates. You know, we need lower unemployment levels. Reagan was really hands off. Reagan let Volcker do what Volcker was going to do. He thought that he could solve the problem by bringing more supply to market as a way to pull down the inflation rate. And so Volcker was allowed to really purvey his trade. So as you can see, for a great period of time there, 1982 and 1983, the US economy went into a deep recession. And during that period, inflation did fall, allowing Volcker to finally start ratcheting rates down a little bit, but he left the spread between the rates that the Fed was charging and the inflation rate still rather wide, which again was sort of a boot on inflation. So he was breaking inflation expectations, but during this period of time, he was the most hated man in Washington. The economy ended up going into a deep recession. Unemployment was almost 11%. Bankruptcies were rampant. It was the worst economic drawdown really since the Great Depression at that time. But Reagan had his back. Volcker continued to operate his policies the way he saw fit. He was undeterred by all the calls for his resignation and the pressures. He maintained, again, that federal funds rate well above consumer price inflation, stood strong. And by the end of the period, we went from having 15% inflation really in 1980, 81, down to about 1.5% when he left office. He handed the baton to Alan Greenspan, and Alan Greenspan presided. Remember the book, The Maestro? Really, it was Volcker that deserved the credit. But Alan Greenspan presided over the Great Moderation, which was a long period of stable prices, which allowed the economy to really flourish. So Paul Volcker was the man who killed inflation expectations, which is what killed inflation and set us up for a long period of prosperity. So the question we really need to answer, the most important question for 2022 and beyond maybe, is COVID inflation wartime inflation and therefore transitory? Or is it something pernicious, something more akin to the Great Inflation 2.0? Well, let's dig into that a little bit. Obviously, the pandemic was a shocking event, a shock to the economy. That initial drawdown in the economy was $2 trillion. Remember, we run about a $20 trillion economy, so it was a 10% drawdown. That was the steepest drawdown we had seen since the Great Depression, very severe. In response, though, to the $2 trillion drawdown, the government deployed 12 trillion, really more than that, 13 plus, but I didn't have that slide, 12 trillion in stimulus. We got fiscal stimulus, abundance fiscal stimulus from Capitol Hill and the Oval Office. We got loan guarantees from the Fed. We really have 4 trillion so far in quantitative easing. So we had a $2 trillion problem we solved with $12 trillion worth of capital. And the amount of money that trickled into households, even though we were amidst a recession, was absolutely historic. So what I'm showing on this chart is disposable personal income, which means after-tax income, going back over the last 5 years or so. Traditionally, and this is not inflation adjusted, but traditionally, households receive, call it 3 to 5% in additional income per year. During the COVID episode, they received raises of 10% overall, which was more than they'd ever received during an expansion, let alone during a recession. So flush with wages or mailbox money, same thing. Also, from the household net worth standpoint, net worth rose at a record-breaking pace, thanks to all of the stimulus, thanks to all of the quantitative easing. Housing prices went up. That's the largest store of wealth. Stock prices went up. Everything went up. So it was the pandemic aplenty. So household net worth rose 32%. Household incomes rose 10%. Americans were absolutely flooded with fortune. Now, we like to spend as Americans. Don't forget 70% of the economy is basically consumer spending. But there were constraints upon what we could spend on. We couldn't spend on cruise ships and hotels and restaurants and the experience that we'd like to spend on. In fact, during the pandemic period, we spent $312 billion less on services than trend. So what'd we do? Well, we spent it on durable goods, online shopping, furniture, Pelotons, cars, whatever we could, because we were spending $460 billion above trend. So services spending went down because of the lockdowns. Goods spending went up because consumers were so flush with capital. And the goods inflation is what's driving overall inflation. So it's important to understand why we have inflation right now and what's really driving it. So this is the contribution, and it's going to be a build, so prepare yourselves. This is contribution to core consumer price indices year over year. The largest contributor, really, in terms of size and weighting within the CPI is rent. Rents tend to be somewhat consistent, as you can see in this chart. Here, there was a little dip during the pandemic period, now a little leg higher, but basically on trend. Here are services ex rent. So you can see services are actually the largest driver of consumer price inflation. And because of that drawdown in consumer spending, you can see that tapered off a little bit. And since the pandemic has started to recede, that services spending and the inflation associated started to come back, but still basically on trend. This is goods ex used cars. Now, what you can see is during the pandemic period, we saw a lot of inflation from goods. Think about all those things that you bought online, or they're in containers somewhere, or new cars, or my mother's ice maker. Lots of things were delayed because of abundant demand and scarce supply. That created goods inflation, which typically we don't really have. And the biggest driver of inflation was actually used cars. Now, if you take this chart before the pandemic, what you'll recognize is that goods not only didn't contribute much to inflation, but they were actually on average somewhat deflationary. So it's really out of the ordinary for inflation to be spiking to this degree, specifically from the goods side of the equation. But that is the result of all the excess stimulus that went into our pockets in terms of income and wealth that we then spent on things. The largest contribution, almost 50% to the inflation readings you're seeing today, are from automobiles, both new and used. And there's a lot within the press about semiconductor shortages. Well, the reason why there's a shortage of automobiles is because they've run into a shortage of semiconductors, and automobiles consume a lot of semiconductors. And with the excess demand in place, this creates a lot of inflation. I think used cars were up 40% in terms of prices year over year. Some of them are more expensive than the new cars. It's kind of crazy. Trying to buy my son a car, it's really a challenge for this economist. I need him to stay, 16 a little bit longer. Anyway, so if you look at semiconductor lead times as sort of a measure of how distorted the supply chains are or undersupplied the market is with semiconductors, we're really at basically 2x the lead times that we traditionally receive. Now, when you have supply shortages, unless the government interferes, that should incentivize, think about that supply curve, prices are up, what do? We add more supply. So it incentivizes producers to generate more semiconductors. So we should see twice as much global semiconductor capital expenditure activity over the next couple of years compared with the average here going back to 2002. So the cure for shortages really is capital investments, and many of the largest supply or semiconductor fabricators have committed to just that investment. Now, I do think the supply shortages will clear. I think that's a function of supply and demand if the government doesn't intervene. But there are some structural risks that we need to dig into a little deeper. So structural risk one is labor inflation. Right now, wages, or in this chart, average hourly earnings, are basically rising at a degree we haven't seen since basically the great inflation of the 1970s. And in fact, there are 3 million fewer laborers today than there were pre-pandemic. Now, there are pandemic reasons for that. And we can see some of that in the breakdown of the labor participation rate. So some of it is because people have decided, we had clients who decided, I've had it with all this stuff. I don't need as much money as I wanted or thought I needed. I'm just going to retire. I'm done. So you've got aging that's declined or taken away a little bit of our labor participation. Then you have elevated unemployment, but that is clearing. And then you have the other category, which is really associated with people staying at home, fear of the pandemic, enough capital in their bank accounts not to worry about what their job function really looks like for the time being. But all of that is going to clear. And in fact, it already has started to clear. Labor participation rates in January ticked up at a higher level than we'd seen any time during the pandemic recovery. The other thing to recognize is as the economy digitizes, excuse me for just a second, loading meeting controls. As the economy digitizes, the component of labor share per unit of GDP actually falls. So our share of labor compensation is about 60%. And as we digitize, we can frankly do more things with fewer people. That's just a consequence. So what we need is more laborers coming to market, but because of digitization, we actually need fewer laborers to do the things we've done in the past. All right, so the other side of it that we have to be concerned about is energy prices, right? So this is oil adjusted for inflation going back to the 1970s. As you can see, there were those huge spikes that I referred to during the Great Inflation. But the highest oil price that we hit actually occurred back in 2008 as shortages and speculators sort of took over. Today, we're at $94 a barrel, which factors in everything that's going on in the Ukraine. I'm sure we'll have questions about that. The question is, and somebody sent this in already, I think, will inflation prove, or oil inflation prove to be permanent? Well, the way you clear oil inflation is that you produce more oil. So this chart on the left shows the balance between global oil production and global oil consumption. What I've highlighted in green is when consumption falls below the level of production, which is what happened during the COVID episode, prices fall quickly. But then when the economy restarted and the level of oil demand and consumption rose above production, then you get into an inflationary situation, which is where we are today. According to the EIA, we should see some resolution to this. Inventory should start building and some of the upward pressure on oil prices should abate. Now, the other thing to recognize, kind of like our labor intensity, is we use a lot less oil in the economy than we used to. Recall that I said oil accounted for about 15% of the CPI back in the 70s. Today, it's less than 5%. And from an oil intensity standpoint, it used to take about a barrel of oil in the 70s to generate $1,000 in global GDP. Today, it takes about a third of a barrel of oil to do the same thing. So we need more oil, we need less oil dependence. Trends are in our favor. All right, this one worries me a little bit more. So rent inflation. We have seen, and again, this goes back to the amount of capital that everybody received from the government, a surge in housing prices unlike any we've seen before. And unfortunately, rents tend to follow the trajectory of housing prices. So this is rent inflation on the left-hand side, Zillow house price growth on the right-hand side. As you can see, there tends to be a bit of a lag. So we should anticipate higher rents going forward. Well, rents really do account for over 40% of the CPI. So we really do perhaps have a little bit of a housing shortage, housing price increase, inflation translating into rent inflation, something to be concerned about. So what do we do about that? Well, the same way we solve all supply issues, we create more houses. Part of the reason we're in the conundrum that we're in right now is that after this is US housing starts, after the great financial crisis in 2008, it wiped out a bunch of builders. And we really were undersupplying the market for a number of years. So we're having to catch up. And that's leading to higher prices for housing units. As rates rise, however, we should see a little bit of cooling in that activity. And we've already seen mortgage applications start to decline. So that could take the edge off the housing inflation, but this is the one that worries me in terms of it being a little bit of a persistent problem. All right, the most important contributor to inflation, going back to the Great Inflation 2.0, is government largesse. How much is the government spending? Well, here on the left, you can see I've chronicled the 12-month rolling deficit, and we went from running trillion-dollar deficits to running over $4 trillion deficits like that. The question is, what does the path forward look like for government spending? Well, we did have wartime spending for COVID. In my head, by the way, I'm stylizing that as World War C. We had a number of stimulus plans. Obviously, Trump passed the CARES Act, which was near $2 trillion. And then there was the December 20th Response and Relief Act, which was like 900. And then we didn't need it, but Biden wanted to jump aboard. And so we got the American Rescue Plan, which was 2 trillion plus. And so there was an enormous amount of wartime spending to combat the issues, caused by COVID and the pandemic. But in reality, those are all sort of one-shot deals and they should taper off. The great inflation spending bills that ended up hitting the Hill, number one, the Infrastructure Act, which at a net spends about $600 billion over 10 years. That's $60 billion a year for 10 years. I can sort of tolerate that. And then, of course, there was Biden's signature proposal, which was Build Back Better, which some economists scored as 2 trillion. Some economists scored at 4 trillion, some at 5 trillion. There was a lot of, number wrangling around that. But needless to say, that would have been an enormous amount of government spending. It would have gotten locked into the system. And because Some of the senators recognized that it would be great inflation 2.0 type spending. They went ahead and voted against Build Back Better. So Biden is still promoting it. And so I saw a tweet the other day where he said the way to kill inflation is the Build Back Better bill. I don't see any evidence of that. And I think we're better off, even though many of the proposals were worthy, I think we're better off without having that increase in government spending persist. So because that bill didn't pass, we're going to have a whole lot less government spending this year and going forward. So here are the federal deficit projections. Obviously in 2020 and 2021, with those huge stimulus bills, we ran huge deficits. But without any more to come and without the passage of the Build Back Better bill, you can see that government deficits should go back down to pre-COVID trend. That's a very good thing. In fact, this will be the largest reduction in the US federal budget deficit since World War II. Pretty amazing. So in 2022, we should see somewhere between 8 and 9% reduction in federal spending from the levels that we had during the pandemic, which is a lot of fiscal compression, and many people are worried about that. But I will state that, in my opinion, the high cash levels on the consumer balance sheets, on the corporate balance sheets, paired with strong wage growth at the consumer level and corporate investment at the corporate level in generating more supply to meet demand, should offset the fiscal compression that will come from that massive deficit reductions. So I don't think we end up having a recession this year. In fact, I think GDP growth, and we actually got some good numbers this morning, believe it or not, crowded out, obviously, what's happening in Eastern Europe. But I think GDP growth this year should run somewhere between 3 and 4%. Again, above our 2% landing strip. But I think, based upon the trajectory that I see, that if we navigate things correctly and we don't have some sort of pandemic 3.0 or 4.0 or new variants, Omni Delta or whatever, we'll end up back at a safe cruising speed of 2% by 2023. Now, in terms of inflation expectations, remember, that's what they got wrong back during the 70s. They didn't manage inflation expectations, and they didn't care all that much about inflation. Well, right now, inflation expectations over the next 5 years, 2022 to 2027, as determined by the futures markets, are running about 2.8%. Now, that's a little hotter than we'd like, but it's not some sort of crazy figure. And remember, over that 5-year period, we're baking in the 7%, the 6%, 5%, the deceleration. When we look out over the next 5 years, inflation expectations between 2027 and 2032, we get right to the glide path that we'd hope to see, which is about 2% in terms of inflation expectations. And so overall, inflation expectations right now are currently in check. The other thing that gives me some comfort is that, yes, the yield has moved a little bit higher on the 10-year Treasury, but we're only at 1.95% today, or we were this morning. And so the market yield on the US Treasury has been a whole lot higher than that, going back over the past few years. And we are on pace to get to 2.5%. But basically, at 1.95%, the market is not signaling that it sees runaway inflation over the next 10 years. So in our judgment, based upon the analysis and the hundreds and thousands of hours that we put in thinking about it, the COVID inflation is really wartime inflation and not the initiation of another period like the great inflation of the 1970s. All right, you still with me? I told you this wasn't going to be easy, right? It's hard to land these planes. So with this, let's talk a little bit more about markets, and let's talk about valuation. Are valuations vulnerable? Can they remain at these high levels? Let's dig into that now. So unfortunately, even though we are on a glide path lower towards maybe that 2% inflation that the Fed desires, we're still going to have 4% plus inflation for 2022. It just takes a while to get there. And this is consumer price index broken down per quarter. It shows you economists' forecasts. And so, yes, it's a glide path lower, but for the course of the year, it's still pretty darn high. Now, the good news is inflation and earnings are actually positively correlated. So in this chart, I'm showing again another cut at the CPI, but I'm adding to it the path of earnings per share growth within the S&P. So even though we had 7% inflation in 2021, we also had 40% plus earnings growth. So just because you have inflation doesn't mean you end up having some sort of earnings recession. In fact, it's the opposite. They tend to be positively correlated. Unfortunately, the bad news is inflation and valuations are actually negatively correlated. So this is a chart that shows you the average PE on the S&P at different levels of inflation. And as you can see, as the consumer price index inflation rate rises, the average valuation falls. So we started 2021 at inflation rate a little bit around 2%, which would have been very supportive for valuations, and indeed it was. But by the time we exited the year and entered 2020, the inflation rate, as we've said, was averaging about 7%, which would put tremendous pressure, you would think, upon valuations. So the question we need to ask first is, how expensive is the S&P 500? Well, the S&P 500 is very expensive. So by most measures, you can find a couple specifically rated to bond yields where the S&P doesn't look all that expensive. But if you look at it relative to its own history, you look at the Buffett indicator, which is market cap to GDP, it's at its 100th percentile. You look at forward PEs, it's 93rd percentile. If you look at values to sales, 3.4 price to sales on the S&P is obviously, I think that's a record level, the most it's ever had. And if you look at the CAPE, Schiller index, 34.4, that's in the 95th percentile. So there's no way really to slice it based upon historical comparisons and not say the S&P is very expensive. And so you would expect, as the inflation level rises, that things would be getting considerably cheaper. Well, here's the decline in the S&P 500's trailing 12-month PE ratio over the last just 6 months. So we went from kind of a ridiculous 34 times back down to a still lofty, but less ridiculous 22 times. And I think that compression will continue even further. So the S&P 500 is expensive, very expensive, but getting cheaper, still expensive in my view. Good news is the non-S&P stocks are already cheap. So while the S&P searches for value, there's plenty of value to find outside the S&P. So this chart takes non-S&P 500 stocks and it compares them in valuation to the S&P 500 stocks. And right now we're at the lowest relative valuations we've seen in decades. In fact, the stocks outside of the S&P 500 are trading at a 25% discount to the S&P 500 itself, which is the cheapest it's been. The chart didn't go back any further, but I hadn't seen any cheaper than that. All right, so let's dig in a little bit more. Let's focus on the US markets first. These are style boxes. We talk a lot about these when we talk about investment strategy within our committee, and hopefully you all are somewhat familiar. But basically up and to the right is the large capitalization, large size growth companies. Think Amazon, Netflix, Facebook, the whole complex. And right now that box is trading at a 65% premium over its 20-year average. Conversely, if you work down into the left, into the smaller cap value box, think the Bank of Hawaii, they're actually trading at a 7% discount to where they've been trading from a valuation perspective over the last 20 years. So you can find places to hide in the US from a valuation perspective. You just have to go down and to the left to get there. The story gets more compelling offshore. So again, the current PE ratio, forward ratio for the S&P is about 21 and change. If you look at the international complex, the all cap world indice ex-US, the PEs are about 14. That's like a 35% discount to the United States of America. So if you really want to go bargain shopping, and I would argue in an inflationary environment where the S&P is overpriced, you want to go down into the left in the US towards small value, and you want to get overseas. Now, this all reminds me a little bit of a movie that I've seen before. So if you look at the chart on the left, and just for orientation, I have ranked, 4 different asset classes per year in terms of rate of return. So 1994, the EFI, the international developed market, was up 8%. Large cap US growth was up 3%. Small cap US value was down 2%. And then you see the emerging markets down 7%. Now, you can see a clear trend here. And this was during the tech bubble of the late 1990s. If you had taken $1 actually $100, will make it more impactful, $100, and invested in the gray box, the large cap US growth box, by the end of 1999, you had $430. If you'd have done the same into the dark blue box, which is the emerging markets box, you would have had $102. So massive performance disparity between large cap US growth and, let's just for comparison's sake, say the emerging markets. Yahoo indeed. But what goes up often comes back down. Now, between 2000 and 2007, you can see that the large cap growth box found its way to the bottom of the periodic table. And in fact, $100 invested in 2000 into large cap US growth ended up being $87 by the end of 2007, whereas $100 invested into the emerging market index ended up being something like $230 by the end of 2007. So there are powerful rotations that occur periodically in the markets, and I would argue now that this is a period of that rotation. So if you look now at where the style box lies over the past 8 years or so, and you go, during this Tesla regime and the ARK, Cathie Wood stocks and all this kind of stuff, we've had another sort of tech bubble within the stock market. So the S&P 500 growth index, as you can see, resided at the top of the periodic table, producing something like 350% return over that time period. And then you see emerging markets, value, everything else was sort of left for dead over this time period. But there has been a shift within the markets, and it actually started last year. It just didn't get a whole lot of attention. So the most speculative parts of that sort of growth tech story did end up underperforming considerably in 2001. So the S&P ended up going on to 25% plus year. But if you look at profitless tech companies within the marketplace, if you look at the Renaissance IPO index, which buys, companies at their IPO basically and runs them out, they were down 15 and 25% respectively. So there was a little bit of turbulence under the blue skies in 2001, and it occurred in the most highly valued portions of the stock market. So the right question to ask is, David, that sounds great, but we've got a lot of money that you're managing. What are you going to do about it? So I'm going to share with you our current equity model composition. So currently, from a geographic perspective, 60% of our assets are within the United States of America, 29% are in developed international markets, and 11% reside in the emerging markets. So we're 60% exposed to the United States of America. From a size perspective, we are 53% exposed to large cap global companies, 19% to small, and 28% to mid-sized global companies. And from a style perspective, we are 20% exposed to the higher value growth-oriented sector. We are 37% exposed to more reasonably priced value names, and 43% resides in the blend space. So if you do a little bit of math, and it's not perfect, but you have to trust me on the numbers, our exposure to that most expensive portion of the market, the large cap US growth box, is only 7%. That is the lowest it's been in my career. I can remember the first quarter of 2001 and the damage that created because we had just too much exposure in that box, and I resolved I would never go through that again. So if you've been checking your statements lately, hopefully you recognize that we've been performing rather well in this downdraft. Certainly that makes me happy. I hope it makes you happy as well, but it's because we have gotten out of a whole lot of the stuff that we rank as expensive, move those assets to where the bargains are, and that has shielded us a bit in this downturn, and I think sets us up well for a number of the years ahead. All right, stay seated, stay buckled. We're almost there. We're almost there. We just got to get through governance, right? Which is everybody's favorite topic, which is why I left it for last. All right, this is the most important man of the year. This is Jerome Powell. He is your Federal Reserve Chair, and he has to decide what his legacy is going to be, who he wants to be, and which of the previous Fed chairs he's going to channel. So option one, he can channel Arthur Burns. He can leave monetary policy too expansive. He can do that to try and achieve objectives of full employment. But during the Arthur Burns regime, which was, again, the period of the Great Inflation, obviously inflation became unmoored. So that's option one. Option two is that he can channel Paul Volcker, who took inflation down, as we recall, from 15% down to 2% by the end of his tenure, and it drifted up a little after, but still remained a third of what it was when he inherited. So is he a dove or is he a hawk? Well, as recently as August 27th, 2021, Jerome Powell sounded a lot like Arthur Burns, with the following commentary. We will continue to hold the target rate for the federal funds at its current level until the economy reaches maximum employment and inflation has reached, or it's okay if it moderately exceeds 2% for some period of time. We hadn't heard a Fed chair say anything like that since the Great Inflation. And the way that he implemented policy reflected his sort of dovish stance on inflation. We saw the Fed funds rate stay at 0 since the pandemic began, and the Fed has been buying basically 120 billion of securities. Quantitative easing went from 4 trillion. The balance sheet is now almost 9 trillion. This is about as dovish as a Fed chair can be. But recently, Jerome Powell has been channeling Paul Volcker. So on January 26, he was quoted as saying, in light of the remarkable progress we have seen in the labor market and inflation that is well above our 2% longer run goal, we are phasing out our asset purchases, and we expect it will soon be appropriate to raise the target rate for the federal funds rate. That is very hawkish commentary. They refer to it as the pivot. He sounds a lot more like somebody who's fighting inflation expectations, like the giant himself, Paul Volcker. I'm showing you the market is now pricing in anywhere from 4 to 8 interest rate increases over the next 12 months. I think Bank of America is at 8 or 9 on the high end, but people are very sure that Powell is resolute in his claims to staunch inflation expectations, much like Paul Volcker. And it's worked. So Powell's big shift, his big change in personality, has led to a big change in inflation expectations. So here I've charted the 5-year break-even inflation rate, and you can see while he was channeling Burns and sort of the dovish version of himself, inflation expectations rose relatively quickly into the end of 2021. And then he pivoted, said he was going to do something about it. He'd use a sledgehammer if he had to, turned into a hawk. And you can see inflation expectations have come down considerably. To me, the most important thing that this chart communicates is that per the market, the Fed has credibility. People believe him when he says he is going to get inflation under control, as we've seen in the previous charts. Now, markets do tend to overestimate, to a certain extent, the Fed rate hikes. So Powell told us he's going to do a whole bunch of rate hikes. The question is, will he? So this is a chart of the effective federal funds rate going back to 2009. You can see during the Great Recession, we took it to 0, and we left it there for quite a while. But when forecasters in 2009 were contemplating inflation and what the Fed would have to do with interest rates, here were their implied federal funds rate curves. And you can see right now, they're expecting, again, 4 rate hikes over the near-term period. So you can see the expectations are for more rate hikes. But during the period between 2009 and 2016, over that 7-year period, they kept expecting the Fed to raise rates, and they never actually did. So markets tend to overestimate, historically speaking, how many rate hikes that we ultimately receive. Now, I am not suggesting that we won't get rate hikes this go round, because I think we will, and I think we should. I am suggesting that the people out there forecasting 6 or 8 rate hikes with a near-term period and 50 basis points in March, historically, they've ended up being out of position. So we will wait, we will be more patient, but I think the market may be overestimating what the Fed is going to do. The market also underestimates the returns that stocks produce during rising rate regimes. So there have been 6 such rising rate regimes. Again, this is the federal funds rate going back to 1984. And I've now labeled in the S&P 500. And in each of those 6 rate hike periods, the stock market actually rose, anywhere from a low of 4% back in 94 to 44% in the late 80s. And in the most recent time period, going back to 2017, the S&P actually rose 28% during the period that the Fed was actually raising rates. So I think the markets tend to overestimate how many rate hikes we'll receive, and that investors tend to underestimate the returns that markets can produce during rising rate environments. Now, switching to the fiscal side of the ledger, Joe Biden, had a choice to make just as well. Number one, he could channel Lyndon Johnson and he could be the Great Society 2.0. And that's really, in my mind, kind of what the Build Back Better legislation looked like. Obviously, Lyndon Johnson took government spending up through the roof. It was a very interventionist, activist government. It was a war on poverty, which, Joe Biden seems to channel. Or he could be Bill Clinton. Bill Clinton actually reformed welfare while he was president. He presided over actually the first budget surplus since the 60s or something like that, 50s maybe. Anyway, government spending as a percentage annual change declined over Bill Clinton's tenure. So which is Joe Biden? Lyndon Johnson 2.0 or Bill Clinton 2.0? That's fairly obvious. Between all of the stimulus programs, the Build Back Better legislation, et cetera, he resembles more an LBJ type figure. And unfortunately, as inflation has risen, to which for him, I think has been a nuisance until now it's gotten sort of center. As inflation has risen, his approval ratings have fallen. Unfortunately, he's kind of the die is cast on this. It reminds me a little bit of Jimmy Carter. Jimmy Carter was aware of inflation. He did try to work with Congress to do something about it. They would have nothing of it. Even though I think he made some policy errors, I think what ultimately killed Jimmy Carter was inflation, and what will ultimately give the Republicans back the House, maybe the Senate in the fall, is once again inflation. So right now, I think because of inflation, Joe Biden, at least on the American, proposals to do his war on poverty, are all sort of dead in the water. But midterm should be and will likely be the midterm year rocky for maybe Democrats. It's just rocky for markets in general anyway. So if you go back to 1950 and you create a composite by averaging together all of the lines and market returns and all that kind of stuff, you can see that markets are traditionally weak in the first half of the year, even negative to kick off January and February, which is something we're experiencing now. Does history repeat? I don't know. Does it rhyme? Seems to. But by the end of the year, markets post-election tend to grind higher and exit with a mid-single-digit rate of return. So not resounding returns, but this again is sort of an average. When we unpack the average, you see there's a little bit more volatility below. So midterm election years can suffer sizable drawdowns. So here's the midterm election years going back to 1962. And the top to bottom drawdown that was experienced in each one of those years. I'll pick on 2018. We saw a 20% drawdown then, but you can see, we had a 34% drawdown in 2022. We had 38 back in the mid-70s. And so there is downside volatility in midterm election years. On average, markets tend to fall 16% during midterm election years from top to bottom, unless something else has happened today. The bottom being January 24th in the S&P. We were down about 12.5% from the high, so not quite to 16%, but basically on script. But good news is something powerful happens once markets find a bottom in their midterm election cycle performance. The recovery rates tend to be the most robust. And in fact, the third year of a presidential term historically is by far the best performance year. And so once a bottom is reached, plus 12 months, on average, markets are 27% higher. So history suggests that things could be rough in the initial part of this year, but that once market catch footing, we could see sizable returns. The other thing that gives me comfort, when the economy is not in recession, meaning that we have a positive growth year, markets on average, or 88% of the time, are higher by year end. So I really do like our odds for 2022. The current disruption notwithstanding. All right, so let's go ahead and start landing this plane. To safely navigate the three turbulences, we have to consider the following. When it comes to inflation, it is our belief that COVID inflation will prove to be wartime inflation, hopefully you agree, and not the great inflation 2.0. So I consider COVID, WWC. When it comes to writing history around the inflationary episode, I think it will prove to be largely transitory. What about valuation? Well, when inflation rises, valuations fall. We're seeing that. The S&P is certainly expensive, although getting cheaper by the day. Everything else relative to the S&P is very cheap. I have seen this movie before. In the environment where the S&P needs to deflate, there are areas you can go to, and that's what I meant about turning off the autopilot, getting more active as investors. It's time to find bargains, get comfortable there, and I think you can stay there and generate positive returns for quite a while. In terms of governance, I think the Fed's bark will be worse than its bite. Remember, the bark exists to manage inflation expectations, while the bite exists to manage inflation itself. I don't think they raise 50 basis points in March. I think it's 25 basis points, and then we may be on a path towards quarter point increases over the next few Fed meetings, but I don't think that they're going to raise rates nearly as much as some of the large wirehouse banks think. At least history suggests that that's not really their tendency. Also, I think President Biden's inflationary agenda with Build Back Better will end up leading to, and by the way, this isn't picking on Biden, this happens to most presidents, but ends up losing the House, maybe losing the Senate. But it means that we're in legislative gridlock for another couple of years. I view that as a net positive for the market. And if you're worried about inflation, you're happy that we're not getting any big new government stimulus or spending programs. So here's the bottom line. In terms of equities, we do think they can be moderately higher by the end of the year. So, I'm optimistic overall. It's a rough ride probably to get to the moment where the markets end up, resuming their upward trajectory, but I don't think the downside is all that great. It's not worth selling and trying to jump back in and paying the taxes that you've accrued over the past few years. Ride it out, just keep your seatbelt on. We'll get through this, and I think we'll end up moderately higher by year end. In terms of size, I do think that the bargains that exist in small caps will end up outperforming the expensive valuations, specifically in large cap growth. Now, one quick aside for those of you home gamers, when I talk about small caps, I'm not talking about the Russell 2000. Almost 40% of the companies in the Russell 2000 don't have earnings that makes them vulnerable to multiple compression. I'm talking about the S&P 600, right, where you have to have earnings as a criteria for inclusion. So I think, again, small cap companies with earnings will outperform large caps. Those that don't have earnings are still going to continue to struggle. In terms of style, we see the lower valuations within the value complex. Think energy, think financials, think staples as more appealing and therefore outperform the growth style. In terms of the US dollar, it's always hard to predict the US dollar. My guess is by the end of the year, the animal instincts or spirits return, people get more optimistic. That ends up being a risk on trade. That means the dollar falls. Plus, the differential between the US growth rate and the foreign growth rates has gotten smaller. And typically that ends up being somewhat bearish for the US dollar. So I think it goes down. In terms of domicile, I think the internationals are a whole lot cheaper, at 35% cheaper. I want to own them. They have outperformed. I think they continue to outperform the US. In terms of US interest rates, moderately higher. I don't see any reason for the 10-year to go aloft and become unglued. So if it rises back towards that 2.5%, that's in line with our desires. And so that would be a good thing. It is going to be hard to make money, though, in a rising rate complex. And so I think bonds are probably dead money for this year. That doesn't mean you should go sell all of your bonds. If you've done your asset allocation strategy correctly with your strategist at Waddell and Associates, you'll know that your bonds are really basically portfolio insurance anyway, and therefore they serve a role in the portfolio, even if in the near term they're not generating a positive carry. The primary threat to all of this is a little bit too aggressive Federal Reserve. There is a history of Federal Reserves causing recessions because they get too aggressive with rates. I don't really expect that from Jay Powell because I think as his core, he believes a lot of this inflation will prove to be wartime and therefore transitory inflation, but we just have to remain vigilant and see where it goes from here. So with that, I do think that we can navigate safely through these three turbulence through the year. It is a transition year. We're really trying to land this plane in 2023, not 2022. But obviously we spent a lot of time and energy thinking about it, still remain optimistic. And I'd be happy, I guess, at this point, if there's anybody still awake on the plane to take some questions.
There are still people online asking questions. Is there a market governor on oil prices? At what price do alternate energy supplies become a limiting factor on oil prices?
Good question. I don't know. What I do know is politicians hate oil. And because politicians hate oil, it serves their purposes to a certain extent to see oil prices rise. So it makes the inflation or the investment parity with alternatives more appealing. Having said that, you'll recall that Biden opened up the strategic petroleum reserves. Now we're in negotiations with OPEC to try and get some oil. So best laid plans on that. I'm not sure that there is a governor, an upside governor on oil prices. You know, we've been at 180 before. We're basically at 92 today. Rig counts have expanded. You know, we're still $1 million a day or 1 million barrels a day below production in the United States pre-pandemic. So there's more supply that's going to come online. It just takes time to get it online. So I do think that the conflagration in Russia and the Ukraine is probably priced in, you know, to a large extent in the oil prices today. So will they go back to 180? I don't really think so, but I am unnerved by the fact that it serves political purposes for the price of oil to go higher, which means that it costs $100 to fill up my SUV, which irritates me every time I do it. So not sure that helps, but we're a lot lower than we were, and we're a lot less energy intensive than we were, but the politicians really want to get us off fossil fuels.
Let's stick with Russia and Ukraine for a moment. Does that conflict impact the internationals and emerging market stocks?
You know, oddly, if you go back and you look at I have a slide for it, but I won't bore you with it. If you go back and you look at the last 5 military invasions, markets sold off prior to the cannons firing and then recovered rather quickly once they started to fire. That was the case in Crimea. That's the case in Afghanistan and other places as well. So pessimism, and Tim did a great job in last week's email capturing this. Pessimism is really at an all-time high here. I mean, if you combine all of the indicators, you go back to the 1970s to find, you know, a time where there was as much pessimism as there is today. And pessimism is a great buying opportunity. So, you know, the news this morning said that Russia had invaded the Ukraine, and the German stock market was up. The French stock market was up. Now, I'm sure those have tailed off now. There's probably been a shot fired. I haven't looked. Things are volatile, thin traded markets, very, very volatile. But history would tell you that you buy stocks when the cannons are fired, you sell them when the cannons start moving to the front line. So I think we're closer to the end of this than the beginning. And the amount of fear that surrounds this is already incorporated into prices.
Well, staying with pessimism, here's the last question that we have time for today. If people are pessimistic, similar to the Jimmy Carter years, does it turn into a recession? And what turns around investor confidence?
If inflation were to start naturally drifting lower and some of the supply issues were clearing, right? I mean, it takes a year to get your car, and that makes you miserable. If you can get it in, 3 weeks, maybe you're happier. So I think getting back to a more normal economic, situation would improve confidence. I don't think just because people are miserable, they go into recession. I mean, the recession in the 80s was caused by the Fed. So I go back to the only real recession risk I see on the dashboard right now is an overactive Federal Reserve. If they really decide they got to be Paul Volcker and they got to put us in recession to rid us of inflation, then I would be super concerned and I would worry about recession. But when you look at the market-based inflation expectation indicators, and they reside right at that 2% mark once you get past the 5-year window, the markets are not really concerned that much about longer term inflation. And for that reason, I don't think the Fed is really that concerned about longer term inflation. And that's another reason why I think they'll end up hiking rates less than people expect. So I don't see a recession on the horizon. The risk to that is that the Fed changed its opinion. It thinks this is inflation 2.0, and Jerome Powell has to channel Paul Volcker.
Okay, with that, David, I think we all feel very safe exiting the aircraft now.
Don't go. Don't go. There's more.
We 2 hours, we'll be there before you know it. Thank you everyone again for tuning in. There will be a replay of this posted on our website. You'll also receive a link via email in the next few days if you came through registering with your email address, with a link to that replay. Also, if you did not know, we author an email every week with similar outlook than this, also to this, similarly to what you've seen today. And we also have links in there to additional information from our team and our wealth strategists. Thanks again for joining us, and we'll see you next time.
Thank you, everybody.